Hey, what's going on, guys? I am Colin Wallace Jr., and I talk about businesses that impact you. That could be retail, consumer, tech, you name it. We'll talk about it right here on this channel. So, like, comment, subscribe, all that good stuff. Let's get right into it. Today, we're talking about 8 mistakes companies make when raising capital. Now, we actually, full disclosure, we wrote an article about this a couple years ago, but I figured that now that we're in this, higher for longer, if you will, rate environment, it's worth revisiting because companies that were getting a lot of easy money before, or definitely easier than now, they're finding it tough, right? So a lot of venture capital money, it's either dried up or the stakes have gotten higher. The bar has been set higher for the companies that they're looking to invest in. So with that, a lot of companies are kind of finding it difficult to raise. And, it's worth maybe revisiting some of these tips that a lot of companies might not have been taking in before because the environment was just different. Now that things are tougher, it's time to kind of tighten your game up a little bit, tighten the screws, and let's see if we can help somebody out with this information. So let's not waste any time. Let's get right into it. Okay, so number one is leaving it too late. So waiting until the bank is dry or almost dry, until those accounts are, approaching zero before you start your process or before you start going to market and saying, hey, we need to raise some money. Now, as a leader of a company, you could argue that the number one job is to make sure that the business doesn't run out of cash. So if you're in a position where you're going to investors for them to do diligence on your company and to hopefully give you money, and you're saying that you have arguably not done so well at your primary responsibility, that's a red flag, right? To a lot of investors, that can be a red flag. Now, are there extenuating circumstances that can cause that? Absolutely. But you're starting behind the 8 ball, or you're starting from a difficult position if you're coming to an investor last minute and saying, hey, we really need money. That's one. And two, it puts you in a very difficult negotiating position, right? If you're coming to the table and saying, hey, I really need this money or else our business is gonna go under, that investor can give you any kind of terms, and you might be more willing to take it or more liable to take it because you don't have any other options, right? So the last thing you want to do is be in a position where it's already tough to negotiate, or it's already tough to land a deal as it is when you're raising capital for your business, and to be in a position where you're starting on defense, right away. That's not a position you want to put yourself in. So instead of that, what should you be doing instead, right? So the way we kind of look at it is you should look at capital raising not as kind of a 6-week or a 3-month or whatever happens to be sprint. You should look at this as a year-long ongoing process of something that you're doing all the time. You should always be building relationships with investors. You should always be, refining your pitch, refining your materials, taking the temperature of the market and seeing what your valuation is like, and, what different investors are looking for and that sort of thing. That should be an ongoing, if not daily, but weekly or monthly part of your process, so that when the time comes to raise, you're not last minute, you're not behind the 8 ball, and two, you already have warm relationships with the right investors, because the last thing you want to do is bring the wrong person on board because you just needed the money. So that's a great way of kind of looking at it, as to having, these long-standing relationships that you're always cultivating here and there, and then when you need it, you can tap the right people who are going to come to the table with you, as equals, as opposed to, a very imbalanced power dynamic. And then two, it also gives you more, or three, I guess we're at, it also gives you more predictability in your business, right? Kind of, when that capital is going to be coming in, you can predict it a bit easier. And you also know a bit more of kind of, okay, here's how much runway we have. I should start raising 6 months or a year in advance, where I should kind of have these people tapped so that by time I need it, it's already there, right? So that's one. Okay, so two then is not raising enough money. And on one hand, sure, you might want to go in and be modest, be conservative, that sort of thing, but that can actually hurt you in the long run. One, because you're not actually going to be able to hit those goals that you're telling the investor that you're going to hit. And two, kind of down the road is if you don't hit those numbers, it makes it look like you don't have a good handle on your business, on your numbers. It kind of seems like you kind of pulled that number out of thin air, as opposed to, no, you were really just trying to be modest, be respectful, and then it ends up biting you in the butt anyways, right? So with that, then how do you know how much to raise, right? So one, it should be enough to complete your current milestones, right? Like that's number one. Two, it should be enough to reach your next major valuation or your next major milestone point. Whatever that next checkpoint is, that major checkpoint, it should be enough to hit that, right? And then three, if you can get there, it should be enough to reach profitability. That, especially in this market, so many investors now want to see profitability. So if you're an early stage company, that's something that you're definitely should be thinking about. If you're already profitable, then, maybe you either disregard that, or if you're not at industry best practice or industry standard in terms of what your margins are, you want to be able to get to that with whatever that next raise is. So you're really thinking about what's that next major checkpoint. And the next time we're going to raise capital at a better valuation, that's the amount of money that you need to go from A to B. And of course, leaving a bit of extra wiggle room for if things go wrong, right? Like you don't want to raise down to the penny and then something happens out of nowhere and you have no flexibility to maneuver, to be adaptable in your business, which is a big part of just what business is, right? So you don't want to be overly prescriptive, but you do want to have a tight, use of funds and that sort of thing. And we'll probably get more into that later. But just knowing what does it take to get from A to B, B being that next big milestone or checkpoint or valuation for the business. Okay, so three, pitching any and every investor under the sun, just getting a list of names and just, spamming and praying. That's definitely not what you want to do. And you'll actually waste a lot of time doing that. So of course, in the ecosystem of capital providers, you've got everything from individual investors and angels to VC, private equity, family offices. There's tons of acronyms and names and different groups out there, but they all play a slightly different role in the landscape, right? So obviously VCs, individual angels, and that sort of thing, they're looking at companies that are a little bit younger or earlier in their growth or in their life cycle stage. And, private equity and those folks, they're looking for companies that are a bit further along. So you don't want to be reaching out to those types of capital providers if, as we talked about before, you're not even profitable yet. They're not going to be looking for companies like that. And as you break that group down, so even within private equity or within VC or within family offices, they all have different things that they like or dislike to invest in. They all have their own investment thesis. And essentially, as great as you think your company is, if you don't fit their thesis, they're not going to look at you, right? Or if they do, it's really a long shot. So you want to do a bit of that homework up front to understand, what's their thesis that they've probably posted on their website. That's kind of the bare minimum. Two is looking at some of their deal history, some of the things that they've liked, some of the exits that they've had, some of the successes that they might have talked about. And then three is kind of building a relationship. And as opposed to kind of saying, hey, this is the amount of money that we need, give it to us now kind of thing. Really maybe reaching out for a coffee chat or so and just really understand, hey, what is it that you like these days? Obviously, markets are different. Has anything changed in your thesis? How are you thinking about markets? What are you looking to add to your portfolio? Are you overweight or underweight in any areas? Are you looking for something different? That type of conversation is what you'd rather have with an investor, and picking kind of a few target ones that you think would be best fit for you and reaching out to those first and using those conversations to determine the rest of your outreach approach. So if you have those first, say 5 conversations and they're all going left, they're all going the wrong way, then you might want to kind of, go back to the drawing board, reevaluate certain things. If all those 5 conversations go really well, you think you've really identified the right niche for you, then great. You can expand that list and target a bunch more investors that fit a similar profile. But less is more in the beginning. Get really precise. It's almost like a marketing, brand persona exercise, really finding out your target market, not just for your business, but for investors as well. And then diving deep from there once you figure that out. Okay, 4, leaving out a detailed use of proceeds. Now, if you're a company that's a bit further on, I'll get to you in a second, but for companies that are a bit more junior, VC type companies, a lot of times they might think, okay, the financial aspect doesn't really matter because we're young and, those numbers are made up anyways. That might be true for the, your revenue projections and that sort of thing. But in terms of the actual way that you will use an investor's money, if they are to cut a check for you, you need to have a very detailed plan as to kind of what your process is and what you're planning to do with that money to get from, again, as we mentioned before, from A to B, that next milestone, that next checkpoint, as well as kind of contingencies and plans in place for, okay, if this goes wrong, here's what we'll do. If that goes wrong, here's what we'll do instead. Just showing that you've thought through some of this. Obviously, anything can happen, especially if you're a younger company, but just showing that, hey, we've been thoughtful about this. We're being respectful. We're being good stewards of your capital. That's kind of what they want to see and what will go a long way to showing that investor that, okay, my money is in good hands with this team as opposed to someone else who maybe hasn't thought of that. And if you're further along, if you're a private equity kind of type in investable company, that's even more important because those guys are looking for a return a lot sooner. So you should have even more clarity as to what you're going to do with that money, since you're going to have to give it back to them in 3 to 5 years kind of thing. That's extending a bit now these days, but still the idea is that they're not looking at you the same way they're looking at a more junior, venture capital or angel type company. So you really want to have nailed in on, okay, yes, we're asking you for money and this is what we need it for, but not just that first heading, kind of the sub bullets that go underneath that. And, some plans in place if things change and that sort of thing, what your expectations are of kind of how that will evolve, again, going from A to B. Okay, so 5, this is an interesting one. Misalignment on how long management will stay on. So there are some times when, a founder, CEO, the team is looking to raise capital, but different people within the team or the founder or whoever it may happen to be has a certain idea of how long they want to stay on or what they want after this deal is done versus what the investor wants versus what they might be communicating publicly, despite what they might internally feel themselves. So it's a bit confusing, but basically what I'm trying to say is that different investors are looking for different things, not just in terms of the company, the industry, subsector, that sort of thing, but also in terms of management's level of involvement after the deal is done. So there are some investors out there that want to, they want to do a full takeover and they want a very neat and orderly transition, but they want that founder, out of there. I don't want to say ASAP, but they're looking to take over the business themselves. They want to run it. They're looking at you for just kind of some initial advice as to, how to transition, and then they're off to the races. And then there's other investors who know they want to cut that check, but they want you in the seat to see out the full vision of whatever it was that you were planning to do. Not just to the next, valuation or milestone, but they want to see you take it end to end. So it's important to know kind of first within yourself, where are you in that process? Like, is your heart still in it? Is your head still in it? Do you have another 5 to 10 years to give to this? Or do you want to get your money and go sit on the beach somewhere as soon as you possibly can? And having that open and honest dialogue is important, not just with yourself first, but then to go out and find the right investors for you so that you can get a deal that works for you, as opposed to feeling like you're being chained into something that, you don't want to be a part of anymore, or the opposite, where you want to stay on long term, and they're just trying to get rid of you and bring the next guy in as soon as possible. Okay, so this is one of my favorites, number 6, telling a complicated story. This happens a lot, especially in more complicated fields, advanced technologies, healthcare, that sort of thing. You're an expert in your area, and the people that you work with are experts in your area. So it can be hard to kind of dial that back, tone it back a bit when you're speaking to someone else who's not in your world. Now, there's a quote, I think it's from Einstein, who said, if you can't explain it to, a child, then you don't really know it that well at all. And I wouldn't say that about a founder who's dedicated years of experience to this, but there's certainly an art and a science to taking complex material that you put years into mastering and learning and distilling that down so that maybe not necessarily a child, but maybe someone in high school or, an 8th grader or someone like that can understand, right? And a lot of investors, they might be very successful people, but they might not be an expert in your niche, right? And even if you're, as we talked about in a previous point, even if you're doing your homework and finding investors that are in your niche, they're not experts in your business, right? And they might not be experts in your specific subsector or sub niche of this industry. So the best thing you can do, and at the end of the day too, on top of that, at the end of the day, we're all human, right? And we're all going to resonate with something much deeper and much more emotionally if it's easy to understand, it comes to us right away, as opposed to something that I really have to work my brain to understand, even if I do eventually understand it. The idea is to walk them to the end destination of writing you a check as easily, as efficiently as possible, and to have them, nodding their head and, really involved and committed from start to finish. You don't want to give room for them to kind of have to be scratching and thinking and really working themselves to understand the business, let alone why they should invest in the business. So, easy things to practice would be, can you pitch your business to, your mom, your friend, your grandma, your dad, a random person on the subway? Again, nothing confidential, but can you explain this in a way that would get anybody excited about it? And if you can do that, then you're halfway there to convincing an investor who's very sophisticated and is going to have, more resources and everything to do their diligence afterwards. But you have to get them, we're all human, right? You kind of have to get them up out of their seat in those first few minutes, first few seconds, whatever it happens to be. And the easiest way to do that is to be able to explain what you're doing in a very simple, concise, but still compelling way to get them to say, okay, I want to hear more, right? That's the biggest thing. I want to hear more. And if you can't get them to that, it's going to be tough. Okay, so this is another one that I really like and have seen a lot. Poor understanding of your key metrics, right? Now, every business, every industry has different things that are the key drivers, if you will, of the business. And as a leader pitching an investor, it's your job to know what the most important ones are for your business, right? And sometimes for your business, it might be a little bit different than the industry or for other peers or competitors in your space. And you need to know theirs to be able to explain to an investor, hey, this is why we're a little bit different. You gotta judge us in this kind of way, and here's why. That's important, but you still have to know that, right? And the same way you have a customer-facing brand with your marketing team and all that sort of thing, you need a similar, in terms of attention to detail and crispness to your investor facing brand as well. So that's all your pitch materials and all that sort of thing that we all know, but it also goes down a layer deeper to the quality of your financials and your reporting, the models and the spreadsheets that you send over, your ability to understand what drives growth, profitability, and all the different KPIs that are involved in your business. Your ability to present that in a cogent, clear manner is huge, and it's almost equally as important as your customer facing brand because your investors, yes, they want to see the product, they want to see how it works, they want to see how customers interact with it, but you're selling the investor just as much as you're selling the customer. So you need a brand and a marketing and all that kind of stuff for every touch point that they're going to have with you. And that goes beyond the teaser, the one pager. It's the way you speak about the business, it's the way you articulate the details about your numbers, and how you answer tough questions, all that sort of stuff. And your understanding, your grasp of it is just as important as, the investments that you're putting on the marketing side to the actual customers. So don't neglect your investor brand and understanding those key metrics and drivers of your business, and how your investors will perceive that, and how you'll kind of manage those conversations. Okay, and last but not least, being unclear in how to get to the next milestone. So we talked about this before in terms of, again, I'm stressing it so much, but how you're going to get from A to B, and a lack of clarity in what that next milestone looks like and what's actually going to be impactful for that next valuation is, I don't want to keep using the word red flag, but it's an issue, right? And you really want to make sure that you have that nailed down and knowing exactly what's going to drive your business to have a better valuation in the next round, or to, be sold for a higher price, or whatever it happens to be. You want to know what that is before you go into a conversation with an investor about trying to raise money. And that's huge because, you want to know kind of how long is their money going to be tied up for? Is it 12 months? Is it 24 months? Is it 5 years? All those things matter and are important in knowing, before you go into that conversation. And you kind of want to be able to get it down to a point of saying, hey, here's a Gantt chart or a timeline, or however you choose to present it to an investor, of we're here today. The most important milestone that we need to get to make everybody happy and to make everybody money is X, right? It's profitability, or it's product market fit, or it's whatever it is on your dashboard. Here's where we are today. Here's where we're trying to get to. Here are all the steps that need to be accomplished in between, and being very clear on that so that they can see that, they can grasp it, and knowing, okay, here's how we know that we'll be, as we go from A to B, here's how we know that we're on track, and here's how we'll know if we're off track. And if we're off track, here's what we'll do to fix that. If we're ahead of schedule, here's some of the other things that we'll add in, or that we can fold into the process afterwards. But again, being very, very, very clear on what that next milestone is and how you're going to gain, traction and progress, and show that progress in a very linear, step-by-step manner as much as you can. Obviously, we all know that business is not linear. It goes up, down, left, right, things happen, right? But you want to be able to project as much clarity in such an unclear, unpredictable world as possible to an investor. And doing that in a very clear, clean, concise way with confidence will go a long way in helping you to raise, because investors are smart. They've been here, they've been here before. They know things happen. What they're looking for is for someone to be able to say, hey, here are all the bad things that can happen. We've thought about a lot of them. Here's how we're going to mitigate. Here's how we're going to get from A to B. Here's our process. Here's how we'll know we're on track or off track. And here's what we need from you in terms of support, help, guidance, what have you. Are you in or out? That's kind of, the mentality, that you want to have in your mind in terms of how you approach a raise. And obviously it's gonna be a very collaborative back and forth process, because from point number one, you're not gonna leave it too late, right? You're gonna be having these dialogues, these conversations, and you're going to be on the same page as that investor, and you'll take some of their feedback, in terms of what they think might be an appropriate milestone, yes or no. So having that down and clear will go a long way to helping you raise some money. So with that, here's the recap of all of them. I'll put it to the side, but I won't take any more of your time. Again, like, comment, subscribe. Let me know what else you want to see, and take it easy. I appreciate you guys. Cheers. Bye.